Quick note from our attorney here, guys. This is a real estate trends presentation, but we always like to include this in here because at the end of the presentation, you'll see slides that talk about Ironton Capital's investment funds. But this is just a disclosure from our attorney. Everything you see in this presentation, if you do see any projections or any references to an investment with Ironton, please understand this is not an investment or an offering of an investment opportunity. You may see some forward-looking statements. As always, before you make any kind of decision, particularly in the private space or in alternative investments, make sure you're discussing with your attorney, wife or husband, financial advisor, CPA, whomever assists you in making all your decisions. It's very important that they're a part of that process. And so I will not bore you with the details of that disclosure. We're going to pass through this a little bit. And then I will just quickly touch on this for those who are new to the call or new to this presentation and haven't seen or heard of Ironton Capital. Here's our investment committee. I was referencing Lon Welsh earlier. He usually leads the presentation here. He's one of the three of us that spearheads it. But Lon started Ironton Capital, comes from a deep background in accounting and finance, started about 25, 30 years ago, I think, at this point, and sold the largest independent real estate brokerage in Colorado. At the time, it was about 800 agents, $2 billion in annual sales. He sold that to a private equity company. And then in 2022, started Ironton Capital. And then Richard Landry, he is the chief investment officer. He's got very extensive background working with family offices, working at Goldman Sachs. So very impressive resume there. And then Brent Geyers, our CEO, also a very broad background and in-depth background in acquisitions and finance and working for a lot of the big accounting firms across the country. So
Hey,
that
Nick,
is the Ironton Cap. Yeah.
can I pause you right there and talk about the team just for a minute?
Yeah.
One of the things that I love about this group, you included, is that you're not so far removed. You know, I'm an investor, I'm a client of Ironton, but I'm not so far removed that these guys don't know who I am. You know, I had a question actually on one of the investments the other day, and I called Brent, and he picked right up. He's like, "Hey, Joe, what's going on?" I was like, "Hey, man, I had a question on NDF6 on the presentation," and he pulled it right up, was happy to help me with the questions. Lon's the same way. You know, I know most folks that we have on here have probably already invested with us here at Ironton, but I just love that transparency and that ease of access to the guys that are at the front lines. You know, if I'm investing with, you know, private capital out of New York or investing with Chase Bank, I can't call Jamie Dimon. I can't get the CFO on the phone, right? Like that's one of the things that I really value about the partnership with Ironton is you're all very accessible and you're all right looking at the long strategy, but also right in the weeds and happy to help with an individual question. And I really value that a lot.
Well, I appreciate you saying that. I mean, we know all of our investors, and that might sound obvious, but there's a lot of firms who do not. So, you know, we make it a point to always touch base with our investors every quarter. Everybody knows us. We know everybody. And I think that's what makes the group so special. So appreciate that additional commentary, Joe.
Absolutely.
We love having you as an investor, most
Thanks.
importantly. Yeah.
Thanks.
Cool. Well, I'll kick it over to you, Joe, with the real estate trends update here.
Yeah, so let's start with something that has been at the forefront lately, which is consumer confidence. So consumer confidence really soured after the announcement of tariffs. And that really, you know, is represented here on this graph on the right that shows current sentiment. And then the graph on the left shows expectations, right? This blue line on the left just shows that consumer expectations are going down further and further. And if you're not feeling great about the economy, you're not feeling great about your job, you're not feeling great about tariffs, that's going to lead a lot of people to be on the sidelines. Hey, I'm worried about I might lose my job. I'm worried about inflation. I'm worried about where the economy is going. I might want to wait to buy a washing machine. I might want to wait to buy a car. Or most importantly, for everything on this call, I might want to wait to buy a house. And that's leading to a little bit of a stalemate between buyers and sellers, which we're going to talk about probably several times through the slides this evening. But consumer confidence is really scaring people and putting a lot of folks on the sidelines right now. And what you see here on the left side is selling conditions. So where is consumer confidence for selling? Really, really low at 110. almost the lowest that we've had in about the last 3, 4, 5 years. And then on the right-hand side, consumer confidence for buying a house. And you see it was very low in late 2024 and really hasn't rebounded that much. And if you go back and look at 2020, that peak there, what you see, that is when interest rates were like 2%, and everybody and their mom wanted to buy a house. And what do we see in 21 and 22? Interest rates begin to go up, and that consumer confidence for buying a house really, really goes down and falls off of a cliff and really has not recovered. And a big function of that is home prices, affordability, and my favorite 2 words, interest rates. Interest rates are up, and that really puts a lot of people on the sidelines right now.
Joe, touching on the on the lack of buyer confidence right now. So I got a question for you. So
Yeah.
there's a builder here in Denver that we've worked with in the past. Very popular, well-known builder. They have 135 homes on the market in May and June. Can you guess how many homes they sold in that 2-month period?
Whew. I don't want to be pessimistic, so I'm not going to say 0, but I'm going to say about 10%. Let's say 13 of those homes. Oh, lie to me, Nick. Tell me it was more than 0.
They sold 0 homes that had 24 showings across 135 actively listed homes. And so this is a builder that, now on another hand, right, spoke with an investor last week. She had her $1.4 million home in Wash Park listed, went under contract in about 12 hours. So it's really interesting because you really have like these 2 different economies in the residential market. And I think if you've got a house that they're not building any more of, such as a house in a very good location, maybe it's got a backyard, it's a highly favorable asset, those seem to go faster. Now, a lot of the attached housing product that's more built for the first-time home buyer, those continue to sit on the market, and those are often the folks who are most adversely affected by high interest rates and home prices, and of course affordability as a result. So I think that helps paint the story a little bit about the buyer confidence that we're seeing in the market and how low it really is, particularly in Denver, from a residential standpoint.
Yeah, boy, that's a scary number. I mean, if I'm a home builder, you know what I'm doing right now is looking for ways I can buy down somebody's interest rate, looking for ways that I can reduce my price, looking for ways that I can offer some incentives.
Yeah.
Because 24 showings on 135 active listings, what is that? 0.5 showings per month per property. That would make me a little nervous. But I really agree with what you said. Some properties are moving in the first weekend, and I almost call it's a tale of 2 markets, right?
Yep.
Some properties are moving in the first weekend. Other properties are sitting 90 days. What's the average days on market? 45. But you can't look at the average. You got to look at what is the specifics of your property and your inventory, and what do you need to do to get that property sold.
Yep.
Now, big highlight is inflation. Inflation has been improving recently. Will this be reflected in consumer confidence? So inflation came out yesterday and was up year over year to 2.7%. I think inflation, we're probably not going to hit that Federal Reserve target of 2%. I think we need to be prepared for 2.5% to 3% inflation in the coming months. And that can lead to a lot of that uncertainty and lack of consumer confidence. But this is a really interesting one. On the left-hand side, 18% of households expect to move within the next 24 months. And that is really up from below 14% as of about 18 months ago. So 18% of households expect to move in the next 12 months. But look at the right-hand side, that blue line, 36% prefer to rent. So think about that for a minute, Nick. We know that home ownership over the long term is a really great investment, but 36% of households would prefer to rent right now. And the reason for that is some places you can rent for less than the cost of buying a new home. Now, we're going to talk a little bit about it later in the presentation, that long-term home ownership is still a great long-term investment, but a lot of folks are just sitting on the sidelines and saying, hey, it's easier to rent. It's cheaper to rent. That works out better for me in the short term. And so this is part of the strategy at Ironton, which I think we're going to touch on, Nick, is build to rent properties, and having a larger, more diverse rental portfolio is a really good thing right now if you're a landlord. And this actually points to that. A lot of people have asked me, Joe, are you selling your investment properties? No. I look at this slide right here. There's a lot of people that are preferring to rent. I already own investment properties. I'm in good shape. And so I think folks on the call might want to think about that. If you are thinking about selling any of your assets, it might be a good time to keep them because we are going to have a higher percentage of renters in the coming months and short-term time frame. Now, this is another one about consumer confidence. Many renters are struggling. On the left-hand side, what you see is the percentage of consumers that had an unpaid bill in the prior month. And so what I want you to do is look at the very bottom three lines, the red line, the gray line, and that peach colored line there. Out of all adults, 16% of people missed at least one payment in the last 30 days. Now, in red, those are homeowners. Only 11% of homeowners missed a bill in the past 30 days. But in gray, what you see is more than 27% of renters fell behind on a payment in the last 30 days. Now, you might think, well, Joe, you just said it's going to be good to be a landlord, but 27% of renters missed a payment. Okay. Okay. I want you to look at the metric right in the middle. How many of those folks missed out on their rent or their mortgage? Only 6% of people fell behind on their mortgage. And then in red, you can barely even see it. 6% of people fell behind on their rent. In red, only 1% of people fell behind on their mortgage. So we're going to talk a little bit about, are there going to be a coming wave of foreclosures? And this is our first leading indicator. No, there's not going to be a coming wave of foreclosures because everybody is making their mortgage payment. And by and large, most people are making their rent payment. They're falling behind on other things, water, gas, electric, internet, things like that. So again, is there going to be a coming wave of foreclosures? Absolutely not. And then over the far right-hand side, percentage of home ownership in the United States. And you are seeing that go down relatively dramatically over the last 6 months. We are seeing more people rent and fewer people owning homes. I think the economics of home ownership is just harder for people to get into right now. And these two slides are really, mirroring that. Now, this one is a big one, credit cards and credit card balance. This gray line shows credit card balances increasing over time. And currently there is more than $1 trillion of credit card debt in the United States, which is higher than it has ever been. And this is something that challenges people when they're trying to save up for a down payment. If they've got really high credit card balances, they can't save up for a down payment because they're focused on paying off their debt, which is going to tie in with affordability that we've got a slide for here in a little bit. And then credit card delinquencies, very similar to what we saw on that slide a couple slides ago. We are seeing a marked increase in delinquencies on credit cards, auto loans, and really big increase on student loan delinquencies because a lot of folks that had student loan payments had forbearance and delayed payments for the last 5, 6, 7 years. But we are seeing those student loan delinquencies begin to increase on a pretty significant basis.
Yeah.
But with all of that, why should you buy real estate? If you have someone living in your basement, maybe a young person, maybe a roommate, show them this slide. If you continue to rent, and all signs point to it's cheaper to rent than to buy, so maybe I should just rent forever. Well, think about the long-term effect of home ownership. So on the left-hand side, if you were a tenant in 2010, the average net worth of a tenant was $5,400. And then follow that green line all the way to the right. 12 years later, in 2022, when this survey was completed, the average net worth of that tenant increased from $5,400 to $10,400. So yes, that tenant's net worth doubled over that 12-year period. But look at in blue, the average net worth of a homeowner, $187,000 in 2010. Now, at the end of 2022, $396,000. So, Nick, let me ask you, if your net worth is going to double, would you rather it double from $5,400 to $10,000, or would you rather it double from $187,000 to $400,000?
The latter, most certainly.
Yeah. And then if you were to take this chart out over another 12 years, I would be willing to bet maybe a cup of coffee or maybe $5 that you take this chart out over another 12 years, The tenant's net worth is going to double from 10,400 to maybe 20,000, but
Yep.
the homeowner's average net worth is going to double from almost 400,000 to $800,000. So I love this slide because I think if you've got a friend or family or young person in your network and they're unsure about buying a home, this slide really sums up what that long-term ownership is going to do for your wealth creation.
Mm-hmm.
Nick, any thoughts on this one? What do you think?
I mean, it's an obvious one for me. I mean, I think, what I love about, home ownership, and a lot of the people probably own homes here, is you're not only getting it through appreciation, but you're also getting, it's essentially like a forced savings account. You're getting principal paid down every single month. What you see as a renter is what you're always going to be exposed to is rising rental rates. Now, maybe we didn't see that maybe over the last year or so. We actually saw negative rent growth in Denver, about 5 to 7%. A lot of concessions were being given out in multifamily. But we also had hyper supply. And so as we head into this supply constrained environment, or we're already in it right now, and where all those units are about to get absorbed, we're likely going to see rental growth increase. And so, if you're a renter and you want to rent, that's fine. But just know that it's likely that your rent's always going to go up. You're never going to have that forced savings plan. And you're going to miss out on that appreciation owning a home. And so I'll always be a fan. There's always the back and forth argument of, well, is it better to rent and own? It's your situation. What is best for you is what is best. But I like seeing this chart because, if your focus is long-term wealth creation, owning a home is usually the way to go.
Yeah, I completely agree. Now, we did forget to mention earlier, there is the chat box on the right. As we're going along, if you have questions, feel free to put them in the chat. If you agree with us, put that in the chat. If you disagree with anything, put that in the chat. Those are some of our best conversations. When somebody says, hey, Joe, you're wrong about this. Man, I would love to go off on those tangents. So if you guys have anything that you want additional clarity or commentary on, please feel free to put that in the chat box. Now, exactly what Nick was just saying, most Americans still pick real estate as the best long-term investment. My favorite part of this chart is crypto. Did make an appearance in the far bottom right-hand corner that about 3% thinks crypto is the best long-term investment, but real estate, by all folks measure, still heavily outweighs stocks, gold, savings, bonds, and even crypto. And I think, Nick, you and I are in alignment that real estate is still the best long-term investment for Americans.
Yep.
Now let's go ahead and
Joe, we have a question. Do you know if there are places in the U.S. that is making more sense to invest in real estate than Colorado? That is a fantastic question. Joe, do you want to kick that off? I've got an answer as well.
My short answer is yes. I do think there are some places in the United States that are better to invest than Colorado, depending on what you're looking for. If you're looking for cash flow, there's a lot of great areas. If you're looking for appreciation, there may be areas that are appreciating faster than Colorado. If you're looking for a combination of the two, I still really like Colorado because I do think we're going to have, positive cash flow if you put enough money down. I do think we're going to continue to have long-term appreciation because Colorado is still a great place to live. But if you're going to manage a property that's in North Carolina, that's going to be really hard to do. So I think investing out of state can be a good idea if it's an area that you're going to go to. Or this is what I would love for you to touch on, Nick, the National Diversified Funds. I mean, you guys specifically diversify geographically. So you tell us about that. Do you think it makes sense to look at areas outside of Colorado within your funds?
Absolutely. And quite frankly, we don't really invest much in Colorado unless we're building, maybe a luxury home build like we're doing in Bonnie Bray, where it's a for sale project, or maybe a townhome project where they're for sale. Unfortunately, the economics like in Denver just don't make much sense anymore. And on top of that, you've got just a huge reversal in legislation where landlords are mostly being stripped of their protections and it's all being given to the tenant. And so, you'll hear a lot of people say, well, I only invest in red states. Typically, red states have, higher population growth. They've got, they're more business friendly. I personally invest in Northwest Arkansas. If a tenant doesn't pay rent, they're out of there in a few days. Whereas in Denver, it can take 3, 4, maybe even up to 6 months for an eviction, which can just completely erode your cash flow. So in short, there are certainly better places to invest in Colorado, but to tag on to you, Joe, like I do believe in the long-term prospect of Colorado. I think you've got an area that's a high quality of living. People want to live here. They want to remain here. And for that reason, I'll always be pretty bullish on Colorado. But if you look at a lot of the market fundamentals, and if cash flow, for example, is a huge priority for you, it's going to be hard to find that in Colorado unless you look into some, tertiary markets like Pueblo.
Yep.
But with that, there's added risk to going into markets like that that you don't get in Denver. So, great question, though. And we
Yeah.
got another question from Kurt. Do you think it's possible for a person to rent in the Denver market where it is likely less expensive to rent than to own, to buy an investment property in another market with the idea of capturing some passive income to subsidize your Denver housing costs, and at the same time capture some of that net worth by still owning real estate? So I think what Kurt's asking is, is it possible to rent in Colorado, buy properties outside of Colorado for cash flow, and use that to subsidize your housing costs here in Denver? I think that's the question that I'm understanding.
Yeah. So Kurt,
Yeah.
I love this. And I'll give you just a short personal story. I moved out of the home that I owned a couple years ago, and I decided to rent. And so where I'm sitting right now, I'm actually in an apartment in Cherry Creek, and it's fantastic. And when I moved into this apartment in February, I'm the guy that just told you guys 5 minutes ago, you should absolutely own your own home. And I understand the concept of renters' net worth doesn't go up as much as homeowners' net worth. But here's what I looked at. I looked at how much is it going to cost for me to buy a condo in an area that I want, or a single family home that's big enough to put a gym. And I ran all of the numbers, and it would take a big down payment. It would have a high monthly payment and a high HOA for me to get the amenities that I wanted. Or I could rent at a really reasonable rent price, get all of the amenities that I wanted, have a very turnkey lifestyle, which is something that's important to me. And I decided to rent. But here's what I didn't do. I didn't say I'm going to rent and I'm not going to invest any money into real estate. I'm going to rent, but then I'm going to take that down payment and I'm going to take the savings that I'm getting and I'm going to invest that into real estate. And what I chose to do was invest that down payment and that monthly savings in with Ironton Capital in their various different funds. I'd spread it out and diversified even further through their national diversified funds. So in my opinion, I'm getting the best of both worlds. I'm getting cash flow from the MPI investment. I'm getting long-term appreciation from the NDF 6 investment that I have. And I'm getting to live the lifestyle I want at a very low monthly cost. So to answer your question directly, is that possible? Yeah, I think it's possible. And it's actually exactly what I'm doing. Now, if you've got somebody who's renting and they're not going to invest into real estate, I would be a little bit nervous about that. I'm the guy that tells everybody you should buy a home, and I do fully believe in that. And I'm following that by I'm buying homes. It's just not the home that I'm living in. What do you think about that, Nick?
That's great. One important thing to point out here, back in 2020, 2021, you could invest, get some reasonable cash flow, and have a pretty low down payment. You could go into a project with 80% loan to value and capture pretty reasonable cash flow for you to live on, for it to be tempting enough, right? Nowadays, you better be prepared to buy a rental property with 35-40% down to get any kind of meaningful cash flow that's probably going to make any kind of difference in your life. And so, and even at that point, it might be minimum, right? And it's going to fluctuate as well because expenses might go up. And so again, that could knock out your cash flow for a couple months. So, this is a conversation I'm having with a lot of investors right now. And a lot of them are just saying, I can't seem to find the numbers to work, but maybe they want to wait 2-3 years for a better time where they think the numbers might work. Maybe interest rates come down a little bit. But to your point, Joe, what I see doing a lot of analyses on rental properties today and looking at investors, they're getting 6 to 8% return on equity. Which seems to be pretty standard. You could go that route. You could potentially also come into our income fund and make 12%, and we'll get you better cash flow without worrying about many headaches. So there's my shameless Ironton plug for today.
Yeah. So Kurt, what I would say is it possible? Yes. And I think it comes back to something Nick said a few minutes ago. It really depends on the individual. For me, I'm doing exactly what you put in your question. But I might be unique. I'm different than some folks. I don't need a yard. I don't need a backyard or, anything at my house. So excellent question. Thanks for asking that.
Yep.
Now, are prices going to drop? This is really interesting. The buyer and seller dynamics have shifted. If you look at the line in green, it's an estimated 1.9 million sellers. Now, this is not listings, but this is sellers, which is listings, people that are thinking about selling, people that maybe have signed a listing agreement, but the home has not been listed yet. And then buyers in blue is 1.4 million. So what that means is we have more we have more sellers than we do buyers. Now, that's going to lead to people having to lower their list price. But that doesn't necessarily mean that home prices are going to go down. And what I mean by that is if I have a home that the fair market value is $1 million, but I'm very optimistic and I list my home for $1.2 million, and it sits on the market for 90 days, and then I sell it at $1,015,000, and the market value is roughly $1 million, did the value of that home go down, or did my list price go down to the actual market value? And I think that's what we're experiencing right now in single family homes is we are seeing people have to reduce their list price, but we're seeing the overall composite of home value remain flat or slightly increasing. That's different in the condo market, and I believe we have a slide for that. We are seeing some price softening in the condo market, but I personally don't think we're certainly not going to see a 20% reduction in price. We're certainly not going to see 25% reduction in values like we saw during the great financial crisis. But let's see, Carolina had an example. So let's say a property's market value is $1 million, and I'm a seller and I have a really optimistic view and I list that property for $1.2 million. That property sits on the market. I lower the price, and I finally end up selling that property for $1,015,000. Well, the value when I started was $1 million. I was able to get it sold for $1,015,000. That doesn't mean that the value of the home went from 1.2 down to $1,015,000. The true value was only $1 million to begin with. So the property didn't lose any value. What we lost was off of my list price. So many sellers are optimistic in where they're listing their homes, and it's taking longer for them to sell them because a lot of folks are experiencing not as many buyers are out there, which is exactly what this slide is showing.
So Joe, quick question on that. What would you say to a seller who's they want to list their home, whether it's a rental or their primary home, and they want to get this thing under contract in the first month so they don't sit on it and have to take a bunch of price reductions. What is your advice to that homeowner?
Yeah, I would say you need to list your price 2 to 3% below what you think the market value is. If you think the home is worth $1 million, you need to list it for $990, $975. You need to have that home listed below what the market is telling you it's going to be. You need to have it parade ready. You need to be willing to accommodate every single showing. You need to have great photos and great marketing around it. And that comes back to the one you mentioned earlier. You had a property go on the market and sold, I think you said $1.5 million and sold in the first weekend, right? That was obviously appropriately priced, parade ready, and ready to go for being marketed. Now, this slide shows that 22 of the largest metro homes have falling home prices. Now, that means that list prices are coming down because homes are not selling as rapidly, right? And home price growth is decelerating. Now, this is really important. There's a difference between price reductions here and home price growth. What you see is the price growth doesn't go into the negative. It's just not going up as fast as it has been in the past. And then there's a broad range of price appreciation from a number of different experts. I agree over here with the one in blue. I think we're going to see continued home appreciation of 1 to 2% this year. Now, if you have a condo, you probably are going to see some depreciation in your prices. And let's go to this slide here. I want to talk about days on market. Average time to sell a home right now is 66 days. And I think this comes back to what we touched on real early on. Some homes we're seeing sell in the very first weekend. Other homes we're seeing sit for as much as 120 days. If I have two homes, one sells on the first day and another sells in 120 days, what's my average days on market? 60 days, right? Same thing is going on here. It's really a tale of two markets. Are you seeing that with your investors, Nick?
Yeah, quite frankly, a lot with which I'm kind of shocked by. The 350 to $750,000 price point seems to be sitting on the market the longest. One, it's maybe it's a townhome or it's a condo, so it's an attached housing product, which we've seen a lot of supply in. And then you got a lot of first time home buyers they're looking for that type of product, and it's become so out of reach for a lot of those folks, and that's why we've seen the first time home buyer age go up to nearly 36 to 38 years old. And so, yes, I do see that a lot with investors. Like I said, the case study of the investor who sold her house for 1.4 million in less than 24 hours, and then another investor trying to sell her condo in Littleton for 375 that's getting no movement and has been sitting there for 65 days. And so there's a somewhat of a degree of randomness, and some of it I don't understand, but it's really interesting to talk to as many of these investors and see what's going on at all price points in the market.
Yeah. And Jeff had a question that the average days on market seems greater compared to 22, 23, and 24. I completely agree with that. And I don't think we have a localized slide. I don't know if you're here in Colorado, Jeff. This is a national average. I think here in Colorado, we would be trailing on this. I think if we were to go back and look, I feel like our Colorado average in 23 was still around 30 days. 24 was around 40 days. And I feel like 25 in Colorado, we're now approaching 50 days. So I completely agree with you, Jeff. I think in Colorado, it took us a little longer to slow down. But now we are approaching the national average of days on market. Nick, did I explain that well?
Yeah, I mean, there's so many variables at play here that can influence these numbers, right? And so, yeah, this is national. So definitely keep that in mind when you're looking at this graph.
Yep. Equity, we've touched on this in prior presentations. There is a ton of equity. So are we going to have a foreclosure crisis? No, because everybody has equity. If somebody does fall behind on their mortgage, they're going to call one of the real estate agents on this call and say, please help me sell my home because I need this cash. We just have more equity than we have ever had in the past. And I thought we had a slide for that, but maybe I can't find it here. Let's touch on this. If we do happen to have a recession, which there's a lot of debate around this, Nick, do home prices go down during a recession?
Do home prices go down during a recession? I don't know the answer to that, actually. I know mortgage rates go down during a recession.
That's right. Mortgage rates absolutely go down during a recession. Home prices, if you look on the left-hand side, 4 of the last 6 recessions, home prices actually went up. And if you look at 2008, which is what we all like to tie our mind to, which what was the most recent recession, well, home prices went down 19% during that recession. Well, that recession was caused by home prices going down. So if you take that one out, 5 of the last 6 recessions, home prices have either gone up or been relatively flat. So if we do happen to enter into a recession, which again, there's some debate, maybe we will, maybe we won't, home prices are likely to remain flat on a national average, but we will get some relief on interest rates and see interest rates reduce anywhere from 1% to 2% as we exit that recession. So if you've got clients that are worried, or if you're worried that a recession is going to cause a drastic decrease in home prices, I wouldn't worry too much about that. Now, is there going to be a foreclosure boom? I touched on this just a moment ago. This is the slide I was looking for. I love this slide. On the left-hand side in yellow, you see how much equity there is as a nation compared to, in red, the debt that we carry on our homes as a nation. And what you see in the housing bubble leading up to 2008, 9, 10, we had really good equity. And then all of a sudden, all of those poor 228 arms and 3-year arms and 5-year arms began to have troubles. And you see that home values go down significantly, equity goes down significantly, and all of a sudden we are upside down in the aftermath of the financial crisis, where there was more debt on homes in the U.S. than there was equity. Mm-hmm. Well, look over to the right. Debt has gone up, but hasn't gone up all that much from where we were at in 2008. But home equity has absolutely skyrocketed. When those two lines are that far diverged, that is a leading indicator that there will not be a foreclosure crisis. Because again, if I've got $300,000 of equity and I fall behind on my mortgage payments, I'm not just going to hand all that back to the bank. I'm going to call my trusted real estate agent and say, hey, I'm having troubles. We got to get this home sold immediately because I need to access this equity. Another really important point over here on the right-hand side, 33% of homes have mortgages with less than 50% equity. That means 38% of homes are owned free and clear. They're not even eligible to go into foreclosure. And 28% of homes have a mortgage with greater than 50% of equity. So only 1 out of 3 homes would really be at risk of any type of foreclosure if on the left-hand side, we didn't have so much equity. So is there going to be a foreclosure crisis? This slide boils it down into one, I think, very clear representation of no, there will not be. But let's keep going. We touched on this. Absolute ton of equity as compared to mortgage debt. So you don't have to worry about foreclosures. 40% of homes don't have a mortgage, and that number continues to climb. And then I love this slide, national delinquency rate of first mortgages. So that blue line is the delinquency rate, and you see it is 3.2%, which is lower than delinquency has been at any point in the last 20 years.
Wow.
So with that record low, the very first thing before you're going to have a foreclosure is people have to fall behind on their mortgage. Then they have to have really low equity. Then they have to go through the foreclosure process. We don't have a lot of people that are behind on their mortgage, and we have a ton of people with equity. So are we going to have a foreclosure crisis? No, absolutely not.
Joe, it's interesting to see a huge spike right around COVID from a delinquency standpoint. But we didn't see a sudden rush of foreclosures that happened in that time period either, like we saw in 08 and 09, as evidenced by the first spike we see on this chart. What was going on during that time where there was a sudden spike and then a quick decline?
Yeah, so that sudden spike, many of you might remember this. That was the COVID forbearance period where you could call your lender and say, you know what? I'm not making my payments because of COVID. And they just opened the floodgates and said, if you don't want to make your payments or you can't make your payments, you don't have to. And we're going to suspend all foreclosures. Well, a lot of people said, hey, this is great. I'm not going to make my mortgage payment. Well, what they didn't realize, that actually puts you behind on your mortgage. And that caused a massive spike in delinquencies. And then we all get through the COVID crisis. We find out that, life is probably going to be okay on the other side. And then everyone says, okay, you got to start paying your mortgage again. Well, what happened during that time period? Home prices went up 10, 20%. So those folks that did put their payments on pause, they either A, said, okay, I'm going to start making my mortgage payments again and I'm going to get caught up. Or B, they said, you know what? I've gained so much equity. I'm going to sell my home and take the equity out and pay off those back mortgage payments. And that's what you see trailing in 2021 down to 2022. That delinquency goes way, way down because folks were not going to let the bank take that home back when they've gained $100,000, $200,000, $300,000 worth of equity. So I think that's this chart really ties really well with what happens when you fall behind and you have high equity. You don't let the bank take the house. You sell it and you take that equity as your proceeds. So thank you for that question. That's a really good one. All right, let's keep going. This is my favorite graph or my favorite section. Are mortgage rates going to go up or down? So before I predict this, Nick, what do you think? Are rates going to go up or down?
It's crazy. When the Fed started lowering rates, I thought that there was more of a sign that they would go down, but I'm actually more convinced now that there is a chance they could go up a little bit. I don't think they're going to go down much. I think they'll remain pretty stagnant and around that 6.5%, maybe 7% mark. But with this new tax bill that was passed, I think and if Jerome Powell stays at the Fed, I think that there's a good chance that we could see stagnant mortgage rates, if not a little bit of a tick up. What do you think?
I completely agree. I 100% agree. Mortgage rates certainly are volatile, right? And you do see some pretty big swings looking at this chart on the left, but current right around 6.89%. And based on government spending and based on tariffs and other policy decisions, there's a lot more opportunity for rates to go up than there are for rates to go down right now. So
Yep.
I completely agree with you. I think we're going to bounce between 6.5 and 7.25 for the next 90 to 180 days. I don't see anything that's going to cause a breakout in one direction or the other. So what I would tell you, if you're buying a home, you're buying an investment property, I would highly encourage you to lock in your interest rate. I do have clients every now and then that say, hey, I want to float because I hope rates are going to get better. And I see them lose 9 out of 10 times that rates get worse. So I think there's a lot more pressure that could drive this red dot on the left-hand slide up rather than down.
Yep.
And then let's see. Now, here is the slide I was looking for leading economist projections. So in blue, you have the Fannie Mae forecast. In green, you have the MBA forecast. And in white, you have the Wells Fargo forecast. They're all predicting that rates are going to go down over the next 18 months to be somewhere between low 6s and mid 6s. I disagree with this. Now, I don't get paid to predict interest rates every day. I get paid to do mortgages. I think we're going to remain right around that 6.8%. You could take this orange line and just draw it straight across on the right. And I think 18 months from now, we're still going to be right around the same. I just don't see anything that's going to be a breakout move in either direction, certainly not towards the positive side. But I have been wrong before.
Yep.
Now, all of that to be said, interest rates are still really attractive, right? I understand that for the last 10 years, we've had rates in the 4s, but historically, the 50-year average is 7.76. We're currently at 6.8, which is a full 1% below the 50-year historical average. And Nick, let me ask you, do you know folks that bought homes in the 70s or 80s and 90s and did really, really well? Do you know anybody like that?
I do know some people that are like that, and they held forever, and
Yeah.
they're happy. They're happy now.
Yep. So you could buy a home at an 8% rate in the 70s, 12% rate in the 80s, 8% rate in the 90s. You hold that home for 10, 15, 20, 30 years, you're going to make a lot of money. That's going to be true now as well, that somebody buys that home at 6.8%, they hold it for 10, 20, 30 years. They're going to do really, really well and be very happy over the long term. And keep in mind, there's always the opportunity to refinance whenever interest rates go down. And that's something I could talk more specifically about one-on-one if anybody wants to know more about that.
That's an important point you made there, Joe.
Yeah.
I mean, at the end of the day, if you're on a 20 to 30-year time horizon, like you're not going to lose. Pretty much anything you invest in over a 20 to 30-year time horizon is going to make you money. And real estate is certainly one of those things. And so, I mean, one thing that this chart, I do want to emphasize on this chart, right? If we look at the 70s and 80s, we saw really high interest rates, saw high inflation. The gap between income and house pricing was much narrower than it is now, right? And so that's why you see an affordability problem like we're seeing today. Yes, we're below the 50-year average, but that median price that median price to income ratio with buyers is about 7x, whereas it was about 3 to 4x back in the 70s and 80s. So we did see very high interest rates, but homes are still affordable to buyers. Yes, we're below, but homes are more unaffordable than they really ever have been. But to your point, Joe, if you're if you're a buy and hold and you're on a 20 to 30-year time horizon, I would be less influenced by these decisions or by these various metrics. I'd be less influenced by what is today's interest rate, what is the supply demand economics. Because if I'm on a 30-year time horizon here and I can hold to that, you've got so much flexibility in that time frame. And at some point, the interest rates will go down, even if it's in year 15. But you'll still be holding strong with a lot of equity and debt pay down. So
that ties so well with this slide. In 1971, the interest rate for a mortgage was 7.33%. If you waited for interest rates to go down, you would not have purchased a home until 1993. That's 22 years that you would have rented while you were waiting for rates to go down. During that time period, the value of real estate quadrupled. So don't wait to buy real estate and wait. If you're buying for the long term, the home price will never be cheaper than it is today. It will always go up over a long period of time. And if you wait for interest rates to go down, you might be waiting for a very, very long time. Meanwhile, exactly what Nick said, that home price continues to run up, and we see home prices running up faster than wage growth. And you might be priced out of the market while you're waiting for interest rates to go down. So I completely agree. And here's the thing, I get it, right? I understand that it's expensive. I understand first-time home buyers are stressed and stretched with affordability. But I think getting in the game and taking advantage of that home price appreciation is absolutely critical as a young person buying a home or as an investor. I think you're missing out if you don't have your money in real estate.
Well, to add on to that, Joe, let's just say appreciation. Let's just say it's 2%, right? Okay, you might not make much money on appreciation, but if you're buying real estate, there's 4 ways you make money in real estate. There's appreciation, there's cash flow. You might get a little bit of that. There's debt pay down. You will get that from your tenants. And then there's depreciation, which, if you've been following along over the last week, the government just brought back 100% bonus depreciation. So if you're an investor and you want to buy rentals and you want to be an active real estate professional, you can nearly double the tax benefit with the recent passing of this bill. And so it's funny because I talk to a lot of investors who are like only prioritizing depreciation because they've got a high income and they want to offset their income, or they want to offset gains of other rental properties, whatever that may be. So keep in mind, guys, unlike the stock market and some other things, and I'm advocates for those, but you get 4 ways to make money in real estate. And it's not every year that you're gonna, there's not really ever a year you're gonna make it in all 4 ways at its max potential. But if you're not going to get appreciation, you're certainly getting debt pay down from your tenant, and you can really capitalize on the passive losses or the active losses if you're an active real estate professional through the depreciation benefit as well.
Yep, you're exactly right. I think the depreciation is a widely misunderstood metric that a lot of folks don't take advantage of.
Yep.
And the last slide I wanted to cover is I wanted to talk about tariffs and how that is going to have an impact on home price construction. So this is a little bit of a busy slide, so stick with me here. On the left-hand side, you've got, starting down at the bottom, 0 up to 7%. This is the share of total construction cost inputs. So if you build a new home, you're going to need ready-mix concrete, and that's going to account for 6% of your material costs. You're going to need wood, kitchen, and cabinets and countertops. That's going to account for a little more than 2% of your construction material costs. You're going to need asphalt, and that's going to account for 1.5% of your material costs. All right, so that's the graph on the left, or the axis on the left. Now I want you to look at the axis on the bottom, and this is the share of this materials that are imported. And so if you go all the way to the far right, what you see is communication and energy wire. 36% of that is imported, but it's less than 1% of the home price input cost. But what's circled in red there is major household appliances. Nearly 30% of appliances are imported. Think your Samsungs, your Bosch, those household appliances are imported, and there's going to be a tariff on those. But what do you know? That accounts for less than 1% of the actual input cost of your construction materials. So a lot of us are concerned about tariffs are going to increase the price of housing, or increase the price of construction. Fortunately, Lon took the time to find this chart, which brings me a lot of comfort that tariffs are not going to markedly drive up the cost of building a new home, because what you see, concrete, ornamental metal and products, engineering and related services, most of that is made here in the United States, and these are the items that make up a large percentage of your construction costs. So I thought this was a great slide. It's kind of busy. It took me 2 or 3 times to really understand it, but the takeaway here, tariffs are not going to significantly impact the price of a new home. They're going to a bit, right? But not on a level that's going to completely slow down home construction or stall out the new construction market. So I wanted to end on this slide because I really like this one, because tariffs have been in the headlines quite a bit over the last 90 days, and particularly even just the last 48 hours. So let's pause there. What final questions do you guys have for me or for Nick? And we can answer those and then get you guys on with your evening. So put your stuff into the chat, and we'll be happy to help here. So Connie says, I'm looking to buy an investment property, duplex or house with an ADU where I can live in one unit and rent the other. Any suggestions which area to look and how to start? Nick, why don't you talk about that? What area? And then I'll talk about how to start.
Yeah, it's funny because we were looking at there's a lot of new builds, and this is my situation, but there was a lot of new builds that we were looking at in the Lone Tree area, close to that Sky Ridge Medical Hospital down there, and they're building a lot of new stuff with an attached dwelling unit or a third or a separate entrance into a third very spacious bedroom and with its own kitchenette and everything. So, for me to go, you should go here, 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 here. It's a little hard, but I'm looking at places like that. That's next to a lot of job opportunities. If I'm looking at an ADU or specifically with an ADU or a house with a separate entrance, because they're going to be smaller units. So if you can find something that's probably near some job opportunities, maybe the Denver Tech Center down there in Lone Tree, where there's a lot of hospital job opportunities, maybe close to the Anschutz area. That's where I'd personally be looking. I think, Joe, you probably have you might even have a more crystal clear answer than I have there, just given what you see every day.
Yeah, I see a lot of clients buying properties that have either a rental basement or an
Yeah.
ADU. I have one client right now buying a duplex. It's probably the first duplex I've seen in more than 6 months because those prices have run up faster than rents. But I would say the west side of town, basically anything west of I-25, you have a lot more opportunity to find an ADU or something that has a basement apartment. If you're looking in Aurora, you're not going to find an ADU. Wheat Ridge, maybe. Lakewood, certainly. Golden, no, going to cost too much. Littleton, not likely unless it happens to be a new build, kind of like what you were just speaking about, Nick. You might find some in Englewood, but east of I-25, going to be more difficult to find those. But your other question, how do you get started? The most important first step is to get pre-approved for a new mortgage. And that's where I can help you. So I'll put my information here in the chat. And what you would do is give us a phone call. We'll go through some personal information. Where do you live? Where do you work? What type of property do you want to buy? Let's talk a little bit about down payment and talk about what you want to purchase, and we'll get you pre-approved for that new mortgage. So I'll plug in my information there so you have it. And then any other questions, please go ahead and type them in the chat. We'll be happy to help.
Yeah, that's a good question. To your point, Joe, I don't see a lot of houses with ADU, but I'm starting to see more with that separate entrance. In fact, Ironton, we're actually investing in a project, 900 Mariposa Street, 2 duplexes, 4 units total. Each unit's actually going to have a separate apartment entrance for somebody that wants to rent out that unit, or if you want to Airbnb that unit because it'll be part of your primary residence. So I see more and more of that. I think when you think about, building these projects, that makes the most sense. I see very few with ADUs that are part of the plan. Now, again, those are new builds, right? That I see that in most commonly. But I think your best bet's probably going to be, if you can get a duplex and rent out the other duplex, good for you. It's probably the best case scenario. But if you're looking for someone with an ADU, I'd expand your search to maybe something that's got a separate entrance into a third or fourth bedroom.
Yep, I completely agree. Well, that is everything that we wanted to cover this evening.